Investment in securities market are subject to market risks. Read all the related documents carefully before investing.
Hi everyone, Vivek Bajaj here. You know, I love to learn. I love to see a lot of videos, a lot of books, and I always want to share my learnings with all of you. I've been doing this for many years, and I'm very glad that most of you have supported me in this journey. Thank you so much. In this video, I'm going to talk about yen because of late I've been reading about yen and what is happening in yen, and there is something very interesting which is happening which deserves our attention. There's a small presentation which I've made using Claude, obviously, and I've seen multiple videos. I've read a couple of books about the history of yen and how it has worked. So definitely got inspired by some people who have created amazing literature for us. I'm trying to relate what is happening with yen with Indian market and see whether there is any crisis which is visible. The topic of my presentation is the end of zero, start of global crisis. Whether this end of zero is leading or could potentially lead to some kind of global crisis. Okay, let's start. See the presentation in the front. This is the graph of USD JPY. USD JPY, just like USD INR, HT representation where if USD JPY is going up, that means yen is getting weak. And if this is going down, that means yen is getting strong. Now looking at this chart, this is a monthly chart over last so many years, and you see JPY has become very weak, and the level at which it has reached is the level which it reached in 1990. And this 1980 was the period when Japan was doing phenomenally well, and after that the economy just went down, and it has taken quite a lot of effort for this economy to sustain. Because the growth got flattened, because the inflation was also not going up significantly, the interest rate in Japan was quite low. In fact, interest rate in Japan was negative because they wanted the growth to come back. And the negative interest rate essentially means that they don't want you to keep the money in bank. They want you to keep the money in economic activities. But the result of that was a lot of money which was in Japan, in JPY terms, they actually came out and got invested outside Japan. And it is typically called a yen carry trade. So money borrow from Japanese yen and invest in US equity, Indian market equity, or any other risky asset. That was a typical format which has been followed for many years. But now what has happened because of inflation, because of some problem in the economy which we'll discuss, the government has decided to increase the interest rate. Now the impact of increase in interest rate is that one of the reason why these monetary measures is taken is if you want your currency to become strong again, right? Why do you want to make your currency strong? Just from an India perspective thing, why will our country want that our rupee should go back to 85, 90? Because we want our imports to become cheaper. It's great if you're an exporting nation, that if your rupee is getting weaker or if your currency is getting weaker, it's good for you. But if you're a net importing nation or if you're dependent on import for a lot of things, then you want your currency to be strong also, okay? Because currency has become weak, because of inflation, because of prices going up, Japanese government, they tried a lot of things through open market operation to control the weakening of currency, but they were not successful in doing that. Government is increasing the interest rate so that the currency becomes strong. How will the currency become strong? If they increase the interest rate, money which is going out, it will come back to their economy. It will come back to their economy, which will obviously increase the chance that the economic activity will come back to the economy. I hope you're understanding this. So what is happening, and I'm talking about this purely from the application of Indian market perspective. I'm not giving you gyan which is more global in nature. So Japan ends 25 years of zero, okay, a policy which has been running for a long period of time. Now it is getting ended. because they want their currency to now getting appreciated again. Why do they want? Because of the high import cost of energy and other food articles, etc., which they don't have. They're not self-sufficient in terms of these two things. The money which was going to foreign assets, like Japan was one of the largest investor in US Treasury bills. That is coming back to Japan. So already their Treasury holding has got reduced from 1293 billion to 1192 billion, right? What is happening? What is the significance of that? If US Treasury holding of major countries goes down, that means they are selling US Treasury. If US Treasury is getting sold, the interest rate in US will also go up, because there is an inverse relationship between price of Treasury and the interest rates, right? So Japan inflation is going up, interest rate is going up, their Treasury prices is coming down. They are selling US Treasury, which is leading to US Treasury prices going down and US Treasury interest rates going up. So if interest rates goes up everywhere, right, then why will people invest in risky assets? If a US citizen is getting higher interest rate in US, why will the person invest in India? If a Japanese citizen is getting higher interest rates in Japan, why will the person send money to outside and buy US Treasury, etc.? That is the core fundamental of today's condition, that because of war and all the commodity logistic issues, inflation has started hitting the thought process of individual countries. As I said, US also has, if you look at the interest rates of US, the 10-year yield, 20-year yield, 30-year yield, now they've reached a 5% level, which is quite a high level, right? Hello, my name is Vivek Bajaj. I have more than 20 years experience in stock market, and I can suggest you, if you are serious about stock market, download StockEdge app. It will really help you in your journey of wealth creation from stock market. And Indian market, the problem is that we are already witnessing a lot of exits in Indian market. Almost 2 lakh crore has gone out of Indian market in 2026. And foreign ownership has got reduced to 14.7%, which is 14-year low. But interesting thing is that foreigners who are selling equity in India, but they are also buying debt in India. So they're not exiting the country, but they are exiting the equity market in India, because they are finding equity market in India to be very, very expensive. Now there are different reasons why they are finding it expensive. I don't want to get into those, because all these reasons can be negated over a period of time by corporate profit. If the corporate profit is growing, all these reasons will get negated over a period of time. Okay. So Japan, what finally broke a 25-year-old deflation trap? Number one, imported inflation. The Ukraine war and a weak yen pushed import costs through the whole economy and cracked the deflationary mindset. Firm discovered they could raise prices and keep their customers. That changed everything. And COVID plus Russian and Ukraine war, both were deadly combination, where prices of everything just went up, because there was a pent-up demand which led to prices going up, and there was a logistic issue in commodities because of Ukraine and Russia, which led to increase in prices. Wages finally turned. 3 consecutive annual wage round above 5%. So previously in Japan, the wage growth was not there. No one was expecting salary growth, but now they are expecting salary growth because there is a increase in inflation to combat their lifestyle. And yen became self-reinforcing. The zero rate widened the interest rate gap with the US. The gap weakened the yen, the weak yen raised the import cost, and higher import costs produced more inflation. So it's actually a snowball impact. Once this gets triggered, the other thing gets triggered, and then there is a snowball of higher inflation leading to higher interest rate in the economy. US, the problem with US is that as the interest rates in US is going up, and the treasury pressure is always there, so there is everyone is trying to sell US Treasury because of whatever reason. I don't want to get into socio-political reasons why people are selling Treasury, but the US interest rates is going up. So every time there is a redemption of a Treasury, the new borrowing of US is also at a higher interest rate. So overall, if you look at the budget of US economy, The problem is that now their cost towards interest against their borrowing is also actually going up because of the new interest rate regime which they are facing. Okay, and money is flowing out of their country because all these countries now they want to save themselves rather than parking the money in US Treasury and earn interest from them. India. What is the condition of India? Well, India has been a beneficiary of carry trade for sure. If you look at over the last 15-20 years, as Japan kept the interest rates, although there is not much direct exposure. The direct exposure is quite limited. It's not a high. In fact, India's direct exposure of Japan is only $36 billion, which is not a very big amount, right? And it's mostly fixed and it's already hedged. But the problem with India is we have a lot of indirect exposure via dollar and through oil. Because if India imports 80 to 89% of its crude, every $10 increase in price of crude, it actually is almost 14 to 16 billion dollar of impact on us. Which actually, if you look at the current account deficit wise, it's 0.4% of the GDP. So, bottom line is that the more inflation is, the more these kind of war and other things continue for long, ultimately you will start witnessing the impact on economic performance because inflation has a direct impact on all countries' balance sheet. India has already witnessed a lot of selling. You see this slide, but obviously people are not exiting our country. They are moving to debt because debt offers them higher interest rate. There is no souvenir crisis as far as India is concerned. But equity as an asset class for India has been quite a negative, most of the FPIs. And I'm not sure whether this will get recovered considering our gross dependence on import for our energy. By the way, importing less of gold will add a lot of value. We all know that. Prime Minister has mentioned, some people have taken it as a joke, but really we need to think about it that as a country, we need to buy more productive assets, then assets which are natural hedge. It's okay, gold is performing phenomenally well, but the problem with gold is it doesn't add to the economic activity. It becomes part of your drawer, which is not a great idea for a country like ours. So, what next? There are 5 things which we need to be careful of before considering that market is going to be extra bullish. Number 1, Bank of Japan, 31st of July, they have interest rate meeting and let's see what they speak. Number 2, Reserve Bank of India on 3rd and 5th of August has a line. Hormuz and the Brent oil prices, if the prices continues to go up, inflation continues to go up, Japan will continue to increase interest rates, which will have a trigger on all the markets. There is no doubt about it. So do not take that lightly what Japan is going to do. We also have to see what kind of capital flow is happening in the US, whether money is flowing back to Treasury or not. And Reserve Bank of India, who is defending our currency quite well, and they have a lot of short position. In fact, $110 billion of forward book is already there in Reserve Bank of India's balance sheet. So we'll have to see what happens to this and whether any crisis can emerge out of the setup which we are in right now. Japan will try its best that their currency again start appreciating because it will help them to reduce their import cost. Although from an export perspective, Japan does quite well if rupee is weak, if their currency is weak. But we have to have a balance, right? Otherwise, they'll keep on depreciating their currency, which is not a great idea because ultimately currency depreciation reduces the purchasing power and which creates a lot of inflation, internal inflation in an economy, which obviously will demand more salary revisions, which obviously will create a snowball impact of inflation, which earlier it was deflation, because of which yen carry trade got originated. Now if it is inflationary, the yen carry trade, which is literally handling the global markets, will start getting reversed, which is very negative. As far as India is concerned, I think we still have Indian retail investor who is buying Indian stock through mutual funds. I think the whole setup has been quite well designed by the government, where mutual funds Sahi Hai campaign has worked fantastically. But I sincerely hope that retail investors continue to park their money and help our economy, help our markets sustain any big shock which can emerge from the yen trade. I hope this concept was understood by you, got inspired from a lot of people who are sharing sensible knowledge, and I'm sure that you will also share this knowledge with your friends and family and let everyone be aware of what's happening in the world. Thank you so much for watching this video. Really enjoyed it. Bye bye. Please take care and Jai Hind.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.